India today has more than 8 crore investors investing into the stock market through more than 15 crore demat accounts. Interestingly, major portion of these demat accounts are stock portfolios that are managed by the investors themselves. However, the question that we need to really analyze is, are these stock portfolios delivering superior returns through relevant technical expertise across all market cycles? Today, CA CFP Rajit Kothari will devise a strategy that can help build a robust portfolio into equity shares which can deliver superior returns across all market cycles. Let us understand this further. This can be attained by building an equity portfolio through a portfolio management service or a PMS. Let us understand as to what is a PMS. A PMS is a managed investment vehicle operated through a separate demat account owned by the particular investor, which holds investment in stocks managed by a portfolio management company. This portfolio management company has a qualified portfolio manager who, along with his team of experts, decides on the stocks that are to be held and bought as well as sold on a regular basis depending upon the investment opportunities ideas. The minimum ticket size as per the regulatory requirement for a PMS is 50 lakhs of rupees. This corpus can be divided into different strategies managed by a single portfolio manager, which could be as per the kind of companies such as a large cap, mid cap, small cap, or a combination of all of them, or basis the investing style or the theme of investment which might be selected by the investor depending upon the risk appetite, investment objectives, as well as overall financial goals that the investor is looking from that particular investment. The fees of a PMS could be either fixed or performance based or a combination of both of them as per the choice of the investor. Now let us understand as to what are the advantages of investing in a PMS. A. Concentrated portfolio. The number of regulatory restrictions involved in management of a PMS are much lesser than the other investment options. Just to give you an instance, there are no sector specific caps or stock specific caps that mandate the maximum amount of allocation by way of percentage in a particular stock or a particular sector that the fund manager is mandated to undertake in a PMS. Therefore, the portfolio turns to be much more concentrated, spread across a basket of 20 to 30 stocks in which the fund manager and his team has maximum conviction of generating a supernormal return across different times. B. Distinct portfolios. Since the investments are held in separate demat accounts by each investor, the inflows as well as the outflows of other investors does not impact the particular investment portfolio held by that particular individual investor. For example, in case of a mutual fund, since it is a common pool of fund that is managed by the fund manager and his team, inflows by way of fresh investments as well as outflows by way of redemptions will have impact on all the investors since it is a common pool, while in case of a PMS that may not be the case since it is a separate earmarked portfolio. Advantage C. Direct ownership and transparency. Since the stocks are managed through a separate demat account which is under the complete ownership of the particular investor, the investor can enjoy investing directly into the stocks rather than through the indirect route of a mutual fund. Further, there is utmost transparency in a PMS considering the kind of portfolio that is managed by the particular fund manager, as well as in terms of analyzing the past performance and the kind of returns that have been generated across different time frames to analyze. Having gone through all the advantages of a PMS, an investor must bear in mind that it may not be appropriate to say that a PMS is superior to a mutual fund as an investment vehicle at all points of times in all the circumstances. Both have their own advantages and unique features, and the ideal way of going about for any investor is having a kind of balance in terms of having appropriate allocation as per the requirements of the investor in a mutual fund as well as a PMS. Now let us understand as to what kind of investors should opt for a PMS as an investment option. The first kind of investors are those who have got a static equity shares portfolio. We come across several investors who have got an idle portfolio into equity shares that is lying as it is since a long period of time without any kind of active monitoring. In today's times when the market is so dynamic and the kind of investment opportunities are changing daily, it is utmost important to actively manage the portfolio through a managed vehicle which exits the saturated investment ideas at the right valuation and enters the futuristic and new generation investment options on a recurring basis. The best way of going about this is comparing the static portfolio that is lying idle with the actively managed portfolio of a PMS across all different time frames. And invariably, we have observed across several portfolios that the managed portfolio through a PMS turns to do much better than a static portfolio that is lying idle. A good part about these PMSs is that as per the regulation, an investor can also opt for handing over the existing portfolio to the PMS if the valuation of those stocks exceeds 50 lakhs of rupees in place of handing over an investment amount. The PMS manager then takes a call on the stocks that he or she wants to continue in the portfolio and those which they feel they should exit and enter into better opportunities. The second category of investors who are suited for a PMS are those who want a diversification into their equity portfolio. There are several investors who already have a substantial allocation by way of investment into equity mutual funds. When this allocation reaches and crosses a certain threshold, it is advisable to diversify into a portfolio management service so that an investor can enjoy the best of both the worlds of investing through the managed route, which is an equity mutual fund as well as a PMS, and have a diversification in terms of the investment vehicle. The third category of investors who are suited for a PMS are those who have a greater risk appetite and have a preference of investing directly into the equity markets. There are several investors who are ready to absorb the volatility risk in terms of accepting the fluctuations in the valuation of the stocks and are ready to take that excessive risk and also enjoy having a direct ownership by way of holding equity shares across different times. They are most suited to have this kind of investment offering. For any further information relating to the options and offerings for a PMS, contact us at the earliest. Follow us on YouTube and other social media platforms to remain updated from the world of finance and taxation.